But now let's start with you. The Fed decided not to. Janet Yellen and the FOMC cited global economic uncertainty. Did the Fed make the right move?
Well, first, hi, Kathleen. Nice to be with you. Let me say this. Earlier in the dialogue, there was, I think, understandably, a lot of interest in the fact that there was so much focus in her comments in the press conference on the international situation. And I certainly recognize that. But also, although maybe there weren't as many comments and they didn't last as long, she said a lot about the lower outlook for inflation. You know, in my view, if you're going to understand Fed policy fully and clearly, you first have to look at the mandate and where they are in relation to the mandate. And what I heard was that while labor markets may not be fully where they need to be, there's still maybe a little bit of slack. Basically, they're not worried about that mandate so much now. It's the inflation mandate. And it looks like, possibly because of some of these transitory things, that inflation outlook is going to be weak even longer. So I think that was probably the main thing that drove the decision. It was supplemented by these considerations on the international side, but not driven by it. I need to put this thing back in my. I've lost my sound here.
Well, you put your ear back in there, Dr. Broaddus.
Got it in there. I'm all right now, Tom.
Dr. Broaddus with us, formerly the Richmond Fed, working with newfangled television and radio technology. Robert Cinch emails in, listening. We thank you, Bob Cinch, for listening from Amherst Pierpont. The 2-year yield 0.6815. That is way in from 0.80. That's a titanic 13 basis point move, which is extraordinary. Dr. Broaddus, you're out of Indiana University ages ago. So is James Bullard of St. Louis. He's practicing now in taking a neutral stance. How do you think the middle ground switched with the tensions between Jeff Lacker of Richmond and, say, Eric Rosengren of Boston? Where is neutral at this point for the Fed?
I think neutral is probably, at this particular meeting, if I understand the question correctly, Tom, neutral is closer to leaving things where they are today than moving the rate up. And I think that's probably the reason that it came out the way it did. And again, I think it's the inflation outlook that is really the key factor here. That doesn't mean that the other things played a role. Certainly the points about the international environment that have already been covered played a role as well. But the key thing is they're worried about the lower inflation going forward. Let me also, if I could, comment on Mike McGee's point. I think that was a good point. And the question is, as you've said, if you're going to get lower inflation, it's going to be even lower and further away from mandate than you had expected earlier. Why would you even have consideration of a tightening as early as before the end of this year? And I think the key there is to understand that the Fed is a risk manager. And that's really what's going on here. They probably feel, given what they think the outlook is now for inflation, that they'd like to buy a little bit of insurance that, in fact, the inflation performance going forward in 2016 and maybe 2017 could be a little stronger given their economic forecast. So they'd like to buy a little bit of insurance and get the rate up a little bit before the end of this year and maybe a little bit more early next year. They just weren't quite ready to do that today, but they may well be ready to do it later on this year. I think that's the way the thought process went.
If you're just joining us, folks, Al Broaddus with us, a former president of the Richmond Fed. Of course, Lacker dissenting today. Really not much of a surprise there. Kathleen Hays and Tom Keene on Bloomberg Television and Bloomberg Radio worldwide. What a day it's been with markets moving right now. We had to go out in all of the island of Manhattan. We had to find one person who could take a victory lap. He's live in our studio. Carl Riccadonna of Bloomberg Intelligence. You absolutely killed this in terms of the call and the nuances within what Janet Yellen and the Fed said. Let's start with the basics here. What did you hear in the press conference to give you further view forward from your home run call today?
Well, we're going to go back to the McKee question, right? And I think Janet...
Yeah, but there's way too much glory here for Mike McKee. I'm getting no love, Kathleen.
Well, Tom, just let Carl talk.
Continue.
Carl Riccadonna, here he is.
The McKee question, which then evoked this response from Yellen Yellen, I think she knew that it was a dovish press conference, and so this was kind of empty boilerplate language to hold on to some sense of hawkish credentials, where she says, well, we can't let things get too out of control, because then we would have to move aggressively later on.
But DXY weaker, the two-year
yield, they tell you what was really happening in that room.
What do they tell you about October and December?
That the Fed is of a dovish bias. They are in no hurry to go. And Janet Yellen is a unique Fed chairperson because she cares about the dollar. She cares about a strong dollar and the blowback into the economy from that move. You can see the response from her press conference. You have DXY dropping. You have the two-year yield dropping. This means the Fed is going to go very slowly, and I suspect they're going to go even slower than the signal they're sending to you in the dot plot.
Carl, I think it's so important, and anybody who was arguing that the Fed would not move and should not move certainly was looking at the slowdown in China, looking at the volatile markets. Inflation. For you, what has Janet Yellen? It seems to me in the press conference we also heard a lot of what Janet Yellen thinks about the labor market, right? We heard, I think, a certain amount about what Janet thinks about inflation. Chair Yellen, maybe I should say. When it comes to inflation, has the message shifted? Has the Fed finally acknowledged that if you're so far away from your target, that's one more reason why it's tough to move?
Absolutely. So we knew from the Fed, from the July meeting minutes and recent comments, that they're almost where they need to be for the labor market. So that we can kind of check the box. The Fed is not where it wants to be on the inflation front. Janet Yellen emphasized that today, and the revisions to the inflation forecast showed the Fed further off the mark. The Fed is not back at 2% inflation until 2018. That means they're a long way from getting to the point where they really want to be at a neutral rate. And if anything, we watch core inflation more than the headline. I suspect core inflation is going to backslide given the dollar strength that we've seen.
Kathleen, look at the market move. We just had a 0.67 print on the two-year yield. It is extraordinary what
people
we're seeing.
Are watching everything we're watching, and Tom, I'm sure they're listening. I want to get Al Broaddus in, though, because this point about inflation, Al, do you agree that there has been a shift, that the FOMC, led by Janet Yellen, is finally acknowledging that there is a hurdle? When you set an inflation target, you have to pay attention to it. It has to be part of your decision when it's finally time to raise rates.
I do, absolutely. I'm sorry, I'm getting two feeds here.
Well,
let me go back. Sure. Let me go back to that. I think I heard the question now, but yes, I do think that the key thing here has been the persistence of below target inflation. The longer that persists, the longer it seems that the Fed is not doing what it needs to do to hit its basic mandate. So yeah, I think that's playing a role, and I think that played a role today.
Dr. Broaddus, when we look at the moment that we're in, and if we go back to McChesney Martin in 1950, whatever, with Harry Truman and the independence of the Fed, and we move forward through the years where you served at Richmond, we come to a new point. Are the models that we're using today and that Chair Yellen spoke of in the press conference going to be forever changed from what you used or Marvin Goodfriend used of Carnegie Mellon at Richmond, or for that matter, what Jeff Lacker learned in school? Are we in a new paradigm of Fed theory?
You know, certainly it's a very different condition, Tom. It's a good question. A very different condition from what Marvin and I and others dealt with in the 70s, 80s, and most of the 90s. Whether or not the paradigm, kind of the basic way the Fed works is any different, I don't know. You know, you go back to the 30s and you have certainly great differences between what happened there and what's happening now, but today's world reminds us maybe a little bit of that kind of world. So in some sense, I think the broader functioning of the economy still responds to the same forces as before. It's just that in the 70s and 80s, government policies put in place an expectational environment that produced very persistent and hard to defeat inflation. I think we got past that. Now we're looking at a situation where it's more two-sided. We got to worry about too much inflation down the road on the one hand, but we also have to worry about too much on the downside.